Politics, everybody's favorite topic nowadays. That's what we are here to talk about. But not exactly. What we are going to talk about is markets in the context of elections. The US elections are in less than 4 weeks, and investors seem to be getting quite nervous about it. But should they be nervous? Let's find out in this video. Before we begin, I just want to acknowledge that I understand politics can get quite personal nowadays. People are getting so emotional about their parties and candidates that it's getting harder and harder to talk about politics. But remember, as an investor, you need to look past all these things and always focus on the returns you're here to get in the markets. In this video, I'll try to stay as objective as possible, and I'm not going to bring in any bias from my side. I'm just going to look at some data, show you the data, and then we can together decide what's really going to happen. More like what can happen, because nobody really can predict the future no matter what the past tells us. One more thing, while I'm based in Canada, it's crucial for me to understand and discuss American elections because the US stock market represents a significant portion of many Canadians' investors' portfolios, including mine. Plus, never forget that the US is the world's largest economy and a global financial powerhouse, and these political events have far-reaching effects on international markets as well. Plus, generally speaking, American elections are quite interesting. Anyway, no matter what your politics are, I hope you watch this video with an open mind and just look at the data and decide how you want to invest. Let's begin. So those who are here just for the main takeaway, let's start by looking at it. While elections can have short-term market volatility, historical data shows that they have minimal long-term impact on market performance. The overall economic cycle and fundamental factors play a much more significant role in driving long-term market trends. Investors are generally better served by focusing on these broader economic trends rather than making investment decisions based on election outcomes. So overall, what we are going to see is that elections don't really matter over a long period of time when it comes to investing and performance of the market. Presidents and parties in the Congress come and go, but the market does what it does best. That is, look at the economic factors and look at how businesses are doing in that environment and adjust accordingly. So if you were here just for the main takeaway, there you have it. That's all you really need to know. So basically continue investing as if there are no elections. And if you're going to stop watching the video now, make sure to like and consider subscribing. For others, let's get to some more details. A good jumping point would be to look at the last 5 elections and see what happened going into the elections, right after the elections, and 3 months later as well. So the election in 2020, Biden versus Trump. Going into the election, S&P 500 saw 2.8% rise in October. The day after the elections, S&P 500 was up 2.2%, and 3 months later, S&P 500 was actually up close to 11%. If we look at 2016, Trump versus Clinton, going into the elections, S&P down again 1.9% in October. The day after, S&P 500 up 1.1%, and 3 months later, S&P 500 up again 7.2%. Going back almost 12 years, in 2012, going into the elections, S&P 500 was down again 2%. Day after, it was up 2.4%, and 3 months later, it was up 6.1%. So looking at the last 3 elections, we see that the market was kind of dipping going into October, and right after the elections, it started going up. Looking good so far. So far, October 2024 has also been a little choppy. We may see it dipping as we go into the elections. But wait, not so quick. Let's look at what happened in the other 2 years as well. In 2008, going into the election, S&P 500 was down 16.9% in October. Day after, S&P 500 was down again 5.3%, and 3 months later, S&P 500 was down 12.5%. Now, this was obviously very different from the other 3 years we looked at, and it was because of the great financial crisis of 2008. As you might expect, the election had nothing to do with the market going down. It was all the economic factors playing a key role in the market going down. So this is where we start uncovering what really impacts the markets. There are several other factors that are far more important than the elections. Just to look at one more year, in 2004, going into the election, S&P 500 was actually up 1.4% in October, and the day after it was up 1%, 3 months later it was up 4.5%. So the general theme, apart from 2008, which was actually a financial crisis, we saw that going into the election, more often than not, the market is actually a bit down, but then right after the election, it starts going up pretty quickly. And despite the short-term volatility around election, the market has actually shown a consistent upward trend over the long term. If we look at the last 23 election years, S&P 500 has actually provided positive returns in 19 of them. That is 83% of the time positive returns. So this is all good. You could stop watching the video now, expect a volatile October, and then expect the market to go up over the next 3 months. But what's really important is understanding why all of this happens, the short term as well as the long term impact. Let's start by looking at some of the main points in the short term. As we saw, elections often cause increased market volatility in the months leading up to the elections all the way to the voting day. The VIX, that is the measure of implied market volatility, tends to be higher before elections. If there is more uncertainty around the election outcomes, you'll see a lot more market volatility due to the policy changes that might come in because of a different person. Whether the policy changes actually impact the market actually comes later. It's just about the uncertainty right now. It's also quite common for markets to experience sell-offs during primary season and just before the election. And as you might expect right after the election, if there's a surprise, you might see some more volatility. But one thing to remember is that volatility doesn't mean the market has to go down. It could go up or down depending on what's really happening. But what about the long-term resilience of the market? We have already seen that 19 out of 23 election years, the market actually went up. But what does it really tell us? It's basically saying that markets over a long term are actually resilient to political shifts. The market might like or dislike a candidate, but what it really hates is uncertainty. While all this is happening, a lot of investors get spooked out and just decide to sit it out until they have more information. Basically, a lot of them are taking a risk-averse approach until they can really tell what's going to happen. It has nothing to do with the outcome, but more about knowing the outcome. But I also don't want to make it seem like nothing really matters when it comes to elections. There is one thing that actually has more of an impact than the presidency, that is the congressional control. While the presidential race grabs all the headlines, the historical data suggests that what matters more is the congressional control. It can have a much more significant impact on the market, and there's a lot of data backing it up, so let's look at some of those data points. Let's start by looking at when a Republican is the president. In case of a Republican president and a Republican Congress, the average returns have been around 13%. In case of a split Congress, it's about 7.3%, and in case of a Democratic Congress, it's about 5%. So, looking pretty good so far. You might want to have a Republican president if the market just keeps going up when they are in charge, but not so fast. Let's look at the flip side of this. Now let's look at when a Democrat is a president. When we have a Democrat Congress, we have about 8% average returns. In case of a split Congress, this jumps to about 16%, and the same is true when we have a Republican Congress. But at the end of it, when we look at the S&P 500 performance, compound annual growth rate, in case of a Democratic president, the median is about 9.3% and it's about 10% when it's a Republican president. And that's exactly how S&P 500 has an average return of about 10%. And this is a quick view of the S&P 500 performance throughout US presidencies from Kennedy to Biden. As you see, it has its ups and downs because of different factors, but it keeps going up over a period of time. So this is actually a good time to pause a little and reflect upon what you have heard in the media. You might have heard all kinds of shit about these things. It's actually good to listen to arguments from all sides, but when you take decisions, especially with your money, you should look at the data and then take your decisions. So what we have seen from data is that the presidency is not that important when it comes to market. The market adjusts and keeps going up over a period of time. And as investors who need to invest over the next 10, 20, 30 years, we should worry less about the presidency and more about selecting the right assets and companies to invest in. When it comes to voting, you do you. Figure out what's important to you. Is it the economic policies, the social policies, or the personality of the candidate? It doesn't really matter. It's a personal choice and you should take your own decision. While elections can be subjective, when it comes to markets, there are certain factors that are very, very essential and common for all investors. Let's look at some of those. Those are way more important than elections. Those are the things that's going to make you take the right decisions. The first one is the broader economic trends. This is something you already understand. Inflation rates, consumer spending patterns, corporate earnings growth, overall economic growth matters way more. The central bank monetary policy decisions are very, very important as well. This is a lesson I learned very late in life. Macroeconomics is quite important. It's good to have a base level understanding a lot of these things. I make videos about these topics quite often, but also YouTube has so many videos talking about this that you can learn whenever you want to. There are also plenty of books and other resources out there that you can use to learn more about these topics. The next one is looking at the company fundamentals. Yes, this is the most obvious one. Before you invest in something, you need to understand how the company is doing, the financial health of individual companies, the competitive advantages they have in their industries, the management quality and the strategic vision, and of course, the future prospects of what they can achieve. This is also something you cannot be excused for. There's so many free resources out there to do fundamental analysis on companies that you should not be skipping this. The kind of research we could do just within 30 minutes nowadays is something that would be unimaginable for our dads and granddads. So please do it. The next important factor is diversification. Of course, it's diversification. Spreading investments across asset classes is quite important. You already know that. Geographic diversification to reduce country specific risks is also important. This is something we have spoken about in so many videos. The next one is time in the market. As the saying goes, time in the market beats timing the market, and it's true. Compound growth over time has been a key driver of wealth creation for a lot of people. Historically, longer investment horizons always smoothen out short term market volatility. Basically, you don't need to worry about the day to day as you go from 1,000, 10,000, 100,000 to $1 million. The last one is cost management. Make sure you're minimizing investment fees and trading costs as you're investing. Understand the impact of taxes on investment returns as well. Yes, as you go through your journey, do not overlook taxes as well. Make sure you're also using your tax advantage accounts. These are topics that I've covered in several videos, so feel free to check them out whenever you have time. There's also one more thing that I want to talk about, a bonus factor, that is your personal financial goals. When it comes to investing, you need to understand your time horizon and your risk tolerance first of all. You need to understand what you're trying to achieve with your investment strategy. Is it just retirement? Is it retiring early? Or is it something totally different? Also remember that you don't need to have one goal. You can have multiple goals and you can invest for these different goals in different ways as well. The accounts you use, the way you diversify, the assets you buy into will all play a key role in achieving your personal financial goals. Do not overlook any of these factors and always keep your goal and vision in mind as you go through your financial journey. And as we saw in this video, elections are not the most important thing. The most important thing is your long-term vision of your financial journey. By focusing on these fundamental factors rather than short-term political events, investors can build more resilient portfolios designed to weather various market conditions and political climates. And that's what you should be aiming towards. Do not take abrupt decisions because somebody is getting elected and you have no control over it. Just stay the course and keep doing what you do best, that is, invest in the right assets. When it comes to politics, here's how I approach it. Yes, I know you didn't ask me, but come on. The most important thing when it comes to politics is actually policies. A good sign of intelligence and growth is actually changing your mind when new facts come to light, and you should always keep an open mind no matter which party you belong to. In fact, I believe that for a democracy to thrive, the power structure should be changing from time to time, or else it's the people who suffer the most when it comes to a complacent government. On that note, I'll see you next week in a new video. Till then, keep learning and stay on top of your finances. Until next time.